Okay, great. Well, thank you. There we go. Yeah. So we will do our best in this setting here, kind of with a hybrid panel, but really excited to be joined by the three panelists here live in the room, and then we have Caitlin Long joining us virtually from Wyoming. And as is mentioned, our panel, the future of banking, fintech, and payment. Pretty big topic. We have about 50 minutes, 45 minutes to cover it. We will do our best, as the senator set it up so nicely. Tremendous change taking place in all of these areas. And I think you'll see as we get through these experts will cover payments, tokenized money, maybe a little bit of artificial intelligence. There are just so many topics that are impacting the banking landscape, the payments landscape, and the fintech landscape right now, and a lot of merging of these. But just to start, what I'd like to do, I'll have each panelist go across, introduce yourself, and as part of your intro, complete the sentence. In 5 years, the biggest surprise about banking or fintech will be.
Well, thanks for having me. Good morning. I'm John Evans from Vanguard. I'm representing Vanguard's investment management group, and specifically about 9 years ago now. It sounds kind of strange to say it, but literally 9 years ago in April, we launched a fintech strategies team within our investment group at Vanguard. And really, it was to help us focus specifically on really what are these emerging technology trends, right? The idea was formulated probably about 10 years ago when fintech was still becoming a thing, right? Now it's completely mainstream. And we thought, well, with the size of our funds and the mission that we have and the size of our client base, we really need to be out ahead of trends. And so we made that case, and we've been pursuing a lot of strategies, as you see in my title there, around Gen AI, tokenization, digital assets, not crypto, which we'll get into probably at some point, but yeah, so that's me.
Oh, and what in 5 years? What's the biggest surprise?
Sorry. I think in 5 years, so that would put us in 2031. I think markets are fully tokenized by then.
All right, you heard it here. Excellent. Will.
Hi, Will Otisel. Just for everybody else that comes up on panels later, make sure you use both feet when you get onto these chairs. It's a little bit of a swivel process to get on here. I'm first of all, very grateful to be here and speaking to all of you today. I appreciate the opportunity. I lead Citi's Banking as a Service business. I'm part of our global payments product organization. So we come from the transaction banking world. Within that business, we lead 3 core product lines. So we look after our virtual account products, our digital asset payments, and our e-commerce practice, which is like a horizontal across the whole business. So obviously no secrets on where we think convergence is going to happen and sort of directionally why we run those 3 things together. When I think about sort of the next 5 years, I normally get asked this question at the end of the panel. So it's interesting to have to start off with this one. And I always caveat it with the famous old Ray Dalio quote, which is those that live by the crystal ball will eat glass. So everything I say now will be absolutely incorrect following this statement. I think a couple things I would point to. The first is I think we still will not have fully solved the last mile. And so I think the reality is that means that interoperability is still going to be a thing. The second is I actually think we're going to continue to see fragmentation in digital assets in particular. I hope we will start to see some level of convergence. And I think there are 4 things that are going to be highly, highly disruptive over the next 5 years, specifically in the US, but also impacting locations like Europe as well, is things like trust bank charters, direct Fed access, digital assets, and I think the 4th one really being AI and low technical debt. So if you're a fintech and you're riding the AI wave, I think it's a very, very interesting time to be playing in the space. And then for Terminator fans, we will know whether the AI revolution was us releasing Skynet or not.
Yar.
Thank you. So this says here that I am a professor at Columbia, and I teach a course, a very geeky course called the Global Payments Ecosystem. So that's what I do part-time. The other part of my time is spent advising fintechs and helping young people, mentoring them in their careers. So I'm semi-retired. I spent 40 years between 2 places, JP Morgan and Citi. building up their payment securities businesses back when it was not fashionable. I'm glad the dog finally caught the bus, right? And now we're overpaying for these businesses. In some ways, they're making tons of money. And I have also had the privilege of chairing the board of SWIFT. For those who may not know SWIFT well, in the global context, people know it. It is a bank-owned cooperative that people like me, after 16 years of chairing it, did not allow it to get privatized like MasterCard and Visa, so that it could be based on bank-centric activities, right? Having done all that, I call myself basically a disruptive dinosaur, because I'm now working on things we bankers could not solve for. We'll come back to that. My view about the future here, and I've been wrong more often than I've been right, so don't listen to it very carefully. But I do think that we are in a world of more purpose-based, specialized banking and fintech and payments. So instead of having the consumers who, I don't know why, we ask them to think about, oh, you want to do an ACH, a wire, SWIFT, blah, 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 which is just Greek to them. We're going to be much more in 5 years into outcome-oriented capability. So people will choose not the method of their payment, but the outcomes they want, like FedEx or UPS. And fintechs will help the banks, and the banks and the fintechs will break down most barriers. I do agree there'll be lots of last mile issues, but I think we are destined for more collaboration than competition in this space.
Excellent. And Caitlin. Caitlin, are you able to come off mute?
Killing cannot unmute. You know how to unmute. Hidden. Okay, thanks.
Sorry, 1 second.
She is here, just we have multiple laptops.
Hey there. Okay, we're back. Sorry
Thank
about
you.
that. Sorry about
No,
that.
not-
And I'll keep it short to
just
make up for the
time for your introduction.
Terrific. When we did the prep call for this session, I think that the intention was to bring me in as sort of the disruptor, and all of us ended up violently agreeing with each other. So this is going to be a fun discussion, because I come from 30 years in traditional finance, but also got into Bitcoin in 2012. In terms of the prediction, I predict that banks and credit unions will no longer need their core systems within the next 5 years, and they will all be disrupted by tokenization technology.
Excellent. You got some whistles in the audience, actually, on that one, Caitlin. Well, so we will jump in now to some scene setting. I think we'll touch on many of the topics that have already come up in your all's great intros. Yara, starting with you, from a global payments perspective, what needs to be fixed? What still doesn't work? Why is payments this constantly changing, seeking to improve part of the market?
So just a context, right? So roughly we move across the industry about $1 trillion every hour, 24/7, 365 days, right? That's global GNP covered in 2.5 days. That's driven by definition, by trading, because trade is covered under G, right? So the trading and settlement part actually generally works. Yes, you could combine, DVP securities payments together and be much more efficient. But it's still, to settle an FX trade is like $1 to $2 in the end of the day. So that is not what's truly broken. There's risk elements that need to be improved. But what's not being served is, I'll cover three. There's many, but let's cover three. First of all, in the US, we have a significant underbanked and unbanked population. And there is no reason why the richest country in the world cannot solve that, right? We bankers have tried. I've tried when I was in fairly senior roles, and we haven't done a good enough job. So this is one thing that we can do thanks to the fintech and thanks to the new motivation. And legislation can also help because they can help ease the AML KYC requirements in a good way, because those are cost prohibitive at times when the balances in the pockets are low. And second, and you all know this, and many fintechs are solving for it, is cross-border remittances. Whether it's US to Latin America, Middle East to India, Pakistan, Philippines, etc. The average cost of a remittance is 7% of principal end to end, right? Now, thinking about somebody who sends on average $200 a week, right? Hard-earned money to their families. That's not only kind of exorbitant, it's something, there's a social imperative here. And again, lots of people have tried, lots of banks have tried, lots of companies have tried, but again, there are companies focusing on. The third is, even with the disruptions of supply chains, there are lots of small and medium-sized businesses all around the world in the US that need to make, right? And what has happened over the last 10 years is because of more strict and KYCC rules, know your customer rules, we've done a decade or more of de-risking. People like me, when we ran FI, we were basically saying we want to go to the correspondents we know well that are sizable because it's too costly and too risky to deal with others, right? Based on that de-risking, the access people have to a major bank that is in the primary flow and not go through what we call multi-bank, multi-chain payments. That access has been limited. So SMEs are finding it difficult to make payments on a timely basis. And that, again, is something that can be solved for and needs to be solved for. So I would cover those three things because while scale does matter in these games, with the evolution of technology, with the evolution of fintechs and specialization, and the new attitude of banks partnering with fintechs, I think this is all solved.
Great one. So when I hear folks talk about improving payments and especially blockchain-based payments, some of the features that come up are often around 24/7 availability, instant settlement, programmability. I guess, Will, to you, how has Citi thought about what's changed in this kind of need to be on 24/7 and those rails kind of always operating?
Sure. Maybe I'd just like to touch on one thing that Delaware said just about solving the last mile. I was very privileged in the first 10 years of my career to have grown up in Citi's network. I grew up in transaction banking in Africa. Like, that is a hell of a fun place to learn transaction banking because it's grassroots payments. And what I will tell you is that what I thought was kind of interesting about that experience was I used to think that basically this people not being banked came down to things like cost. I can tell you now, we had some phenomenal banks in South Africa, groups like Capitec, who did amazing things. They used to produce a bank account for $4,000 a month. That's 20 US cents a month, right? And the onboarding was completely digital, and your first 5 payments were free. They did not see mass adoption of bank accounts. And so the first statement I would make is that not being banked doesn't necessarily come down to cost, and it doesn't necessarily come down to having the capability or the need to ease friction to actually get online. A lot of it actually comes down to trust. And there's historical reasons why in a market like South Africa, people were not overly interested in taking up banking rails. The second is, if you look at a market like Kenya, who did an amazing job with M-Pesa. M-Pesa was like the market leader when it came to mobile payments, right? And they were so far ahead of the curve, they made all of us look like we were sleeping. It was like 16 years ago that they launched that platform. Absolutely mind-blowing. Within 5 years, there was more money moving through M-Pesa than the entire banking ecosystem combined, to give you an idea of how wide-scale adoption was. Most people think that the thing that solved the banking engagement or people actually having access to that was the mobile tech. It wasn't. It was 20,000 cash-out kiosks. They solved the last mile because I could arrive at a cash kiosk with my mobile phone and get cash from a kiosk. They created the swap system that allowed me to get access to a trade mechanism I could use in my local town. So that last mile is a mission critical component of solving the debanking problem. So I want to just close that statement out because I think it's a very important conclusion that the people often reach thinking it's a friction thing or it's a cost thing. In my experience, it has not been either of those two things. Moving to the question you'd asked on 24/7. So this is one place where I really feel like Citi sort of had a view. We're a very client-led organization. If our clients push us in a direction, we're typically going to go there. And that's always been how we've been motivated. It's always been how the bank has been constructed. So we moved into the 24/7 ecosystem roughly about a decade ago. We really started getting into the space. We had a few experiments in places like Nigeria where they'd launched things like NIFs all the way back to like 2011. But we really got into the 24/7 and near instant thing roughly a decade ago. Today, what that looks like in our ecosystem is we basically have 65 markets where we have 24/7 instant payment platforms. We've launched a 24/7 clearing platform. We were the first bank to do that. That basically allows, if you think about dollar clearing, if you're an Asian-based bank, being able to access dollar clearing in a 24/7 environment is really, really important because most of your clients are transacting off hours when all of us are asleep, right? So that was a very important sort of leg for us. And then when we started looking into the future, I think what was great for us was as the administration started turning the curve and saying, hey, we're more open to tokenization, this 24/7 story around stablecoin and blockchain and the likes, what that meant for us was it was a pretty straightforward shift to start thinking about it in a 24/7 environment for us because we just saw it as part of our overall stack. We could think about it from the same type of framework. And we started with the Citi Token Services platform. So that is essentially an internal blockchain that allows us to optimize money movement for clients of the bank. The reason we kind of started internal was it's probably the easiest problem for us to solve. There's still quite a lot of inefficiency in a bank that's in 100 countries. Trying to move money efficiently around that network is actually quite challenging. And the second problem is that if you think about the industry today, everybody wants to be the new age MasterCard or Visa, right? There is such a race right now to own the network. It seems like every week there's a new layer 1 or a new layer 2 coming out. So that fragmentation I was talking about, I think we're going to continue to see some of that. And I think for us from a 24/7 standpoint, we think that because of that fragmentation, interoperability is a very, very important play. And so we did things very early on with this. So a prime example of this was we connected our 24/7 clearing platform with our Citi Token Services platform. So if you're a client of the bank on the token platform, you can make a payment to a bank who's on our 24/7 clearing platform, completely seamless. And the idea behind that was to leverage some of the 24/7 capability that exists in both traditional payment types as well as tokenized payment types.
Awesome. Yeah, I think we'll come back probably to that interoperability question and some of the public and open versus private and permission. But Caitlin, going to you, talk a little bit about Custodia, and is it some of these problems that have been identified by your fellow panelists that you were looking to solve with Custodia, and how have you gone about that?
Yes, thank you. My background actually touches Delaware. I was part of the original Delaware blockchain initiative led by Andrea Tiniano. I don't know if she's in the audience today, and was working with the Delaware Secretary of State on corporate registrations natively on a blockchain 10 years ago. There is a speech that I would point everyone to by Delaware Chancery Court Judge Travis Laster that is literally 10 years old, called The Blockchain Plunger. And he talks about how blockchain is the plunger that is going to literally clean out the muck of the back office of Wall Street and the banking system. And it has withstood the test of time. He was urging the stock exchanges to tokenize securities because, as he pointed out, The corporate proxy battles, if it's within 10 percentage points, because the Wall Street, the judge's name is Travis Laster, Laster. He's one of the better known judges on the Delaware Chancery Court, and he urged adoption of this technology to be able to have accurate corporate books and records, because the way the stock record system works, it's never in perfect sync with each other. And that's how you can end up with a proxy battle that he said was within, if the vote was within 10 percentage points, nobody really knew who won. So those problems still exist because so much of the stock system and the payment system are still in paper form. And part of the reason that I switched from working as a managing director on Wall Street in the securities industry to the payments industry is because I recognized that if we couldn't get the dollar tokenized, then the benefits of tokenization on the asset leg of transactions, such as stocks, loans, commodities, crypto, would never be able to fully be realized. We've got to be able to get the dollar natively digital, and it's not natively digital right now. Now, in terms of the permissioned versus permissionless discussion, Custodia is partnered with Vantage Bank to introduce the Hazel Network, which is live. We went live with it 3 weeks ago. It is a multi-year initiative that is bubbling up from the community banks to offer tokenized deposit technology to community banks. We have been working very closely with our respective regulators, the Texas Department of Banking, the Wyoming Division of Banking, and in Vantage's case, the Dallas Fed. And the initiative is, we've been literally working on the Hazel Network specific initiative for 15 months with our regulators. And so we're very far ahead of competing networks that are just building, because in Custodia's case, we proposed to the Fed to have a bank issued stablecoin in 2020. And of course, got famously stymied, but we never gave up and we're back. We also were able to have to lock up some of the very important patents in the space, because back then the banks weren't interested in technology, in tokenization technology, in part because the regulators, I think, did a real disservice in discouraging the banks from getting involved, which handed so many of the non-banks a lead. And now the banks are playing catch up.
Great, thank you. So John, turning to you for
Yes.
a little different flavor, I think,
Sure.
kind of from the investor perspective.
Yep.
You've talked about challenges, some different versions of solutioning. When you think about investment, how do you try to weed or parse between the hype and what's really real here, and thinking through that?
Yeah, for sure. And, Caitlin and I did a little bit of work in this space
Very good.
those years ago. I think one common theme is we
Yes.
didn't know how early we were, right, Caitlin?
Right, that's right. We got live with a blockchain together almost 10 years ago.
Correct, yes. And back then it was really just private blockchains, because there was, really no hope of working on other platforms at the time. But I think, the work that we've done, the research and the actual, design and implementation has always been aligned with Vanguard's mission statement, right? To take a stand for all investors, to treat them fairly and give them the best chance for investment success. I think this replatforming of traditional finance on DeFi crypto rails is completely aligned with that, right? We're sort of saying, we've had all these different waves of modernization of markets over the decades. This is another version of it, but it's more fulsome and wholesome across, trading and investing, payments, and money movement. So, sorry, what was the specific
Kind of
asset
parsing
differentiation?
through the hype and what's real as you think about kind of these technologies.
I think there is there's still a lot of hype around linking crypto and DeFi, or I'm sorry, really linking crypto and TradFi. And I don't really think that that's the most exciting use case for investors. I think ultimately, through tokenization, through replatforming, through some of these modernization efforts, we'll be able to offer greater return to investors over time.
Yeah, great, thank you. All right, so digging a little more into this interoperability question, Yara, going to you first on kind of, walled gardens. History tells us maybe they are not successful in the long run, yet I think we do see in this market a lot of development of, private consortiums or private networks. How do you see that playing out over the next couple of years?
So I must admit, I'm now very perplexed and a bit concerned. So, decades ago, banks were into consortium, working together. One simple example, there are many I can quote, one simple example was when SWIFT was being created, and that's seen as a very big success. There was one bank, a little guy called Citi, that had their own Marty system. And they were not very keen because they had a proprietary communication system. They weren't very keen, but everybody else prevailed. And now, by the way, Citi is the largest user of SWIFT and very active in it, right? So it's not sustainable to have walled gardens. And over time, something that is seen as a competitive advantage becomes a commodity and becomes a shared service. So there's lots and lots of those kinds of examples. However, because higher switching costs and friction lead to, surplus economic rent, there is, for those of us, when you run a P&L, you want to grab that 5-10 year advantage. And these days, it may be 2-year advantage or 1-year advantage. So there's a desire to do that. What I'm getting concerned about now, I want what other good examples, is people want some type of wall, whether it's a network, whether it's their own coin, right? Remember Italian banking where every bank issued their own note? How is that different from issuing your own stablecoin that isn't interoperable, right? So those of us who spend our lives trying to bring everybody together so we could have lower friction, easier movement, facilitation, are kind of confused and maybe concerned. Having said that, I'm also very optimistic that with the fintechs coming in and with new technology adoption, while there will be challenges, there will also be pressure to break down those barriers. And I love, Senator, what you said about easing the regulation, both at the state and the federal level, to make that happen. In the US, other countries are doing it very actively.
Great. So, it's clear though, networks matter. And Will, you touched on this a bit just in the last question. And everyone wants to be the next Visa or MasterCard or new layer ones and layer twos popping up every day. In your view, what is that interoperability end game?
Yeah, so it's a good question. I think, I think one thing I always like to start off with when I think about interoperability is if you stick 50 people in a room and you ask them their opinions about managing and moving money, you're probably going to get 75 opinions. And I think that largely comes down into how deeply philosophical payments and money movement actually is, right? And so that is kind of a thing that's kind of deep rooted into human psychology. And I think when I look at Citi's global network today, that's a great kind of philosophical starting point for us, is if you think about the business today, it's in 100 markets, it's got access to like 400 pieces of clearing infrastructure. It's, able to make payments in 140 currencies, 180 different countries. That is inherently interoperability. Like the reality is what our clients come to us for is the fact that there's this interoperative plumbing where even though the local clearing systems are all different, they all operate on different schemas, they're in different currencies. That is a basic version of interoperability in today's traditional finance system. So if I think forward a little bit about what like the future state of interoperability looks like, I actually think in the long run, clients don't really care what the underlying technology is. What they care about is like what the benefit is that they get, right? And so the reality is the future state of interoperability is something that abstracts complexity. It absolutely has to do that. If you don't abstract complexity from your client's baseline, you're never going to get adoption. You're never going to see them using it. So we've done things like this. Actually, we've kind of, I think, taken a fairly open view to interoperability to start. And if I look at things like just some of our even what I've stopped calling some of these platforms legacy platforms, because the fact that they were designed so long ago and still operate as well as they do, they deserve the term legendary platforms. Because they're able to do, I mean, honestly, we've done some amazing things with platforms like connecting some of our global payments platforms into things like alternative payment methods, right? So this idea of walled gardens, you're absolutely right. We've got a very interesting example of connecting our fiat bank accounts into, for example, PayPal wallets, right? Those are examples of early interoperability, pre us getting into more of a stablecoin type of race. But things like the announcements with Coinbase, the way we're thinking about the future states of this are really aimed at exactly that, right? Their interoperability between traditional finance and this future state, because we think that at least in the near term, there is going to be some of this ability to drive some of with the fragmentation, there is going to be a need to drive some of this interoperability.
I think John has a comment. Yeah.
Yeah, just a quick chime in on this. I think there's a compelling analogy between this space where we are now and how the internet developed kind of in the late 90s, early 2000s. I think if we consider terms, we had pockets of connectivity, pockets of networks that were an internet, but it took protocol standardization to get to the World Wide Web. And that's when we could really tap the global value, right? So it's almost like things have to grow up a little bit in walled gardens to get maturity, but then it's incumbent upon all of us to figure out, is it an ISO standard, or what is that protocol level that we can leverage together to weave these things together and make it a global mesh. I mean, that's the real opportunity. The difference with this space is blockchains are governed and maintained by cryptography. So the math has to kind of be complementary for these chains to be able to talk to one another in a meaningful way. But there's at least, I think we're probably about 3 years into some significant innovation to solve that problem at scale. And I agree with Will, like, this all has to be transparent to the end user. Like, we don't even want to try to get people across what we mean by interoperability. It just has to work, right? And I think as equities and bonds tokenize, as shares of ETFs tokenize, as stable coins, so tokenized money and tokenized deposits come online, it'll all ultimately be app driven on the smartphone. And so the user experience will kind of normalize. Like today, when we're accessing a web page that might be hosted in Istanbul, like we're not considering that TCP/IP is figuring out the optimal path to get the traffic back to us. So things like that.
Right. The level of exposure that customer needs to the infrastructure should be very minimal, right?
Yes, exactly.
As an example, we often use at the ABA, and it's like, how many of your customers, talking to bankers, come in and ask, make this payment for me and make sure it runs on FedNow, right? It's just not. Maybe they say, I need this to send immediately and be real time. And the bank can say, great, we've got several solutions for that. But the customer doesn't need to know about the rail. Caitlin, want to give you a chance to weigh in here too, on openness. Where does that help banks? And maybe just from your experience, where does that scare regulators a little bit?
Yes, well, I'll start with the latter, which is the BSA. AML, OFAC compliance. And we've demonstrated, it is amazing how few senior people in the bank regulatory agencies, again, in part because of the disservice that was done over the last few years in discouraging senior folks from learning and getting up to speed on how these systems work. It is amazing how few understand exactly how BSA compliance is possible, but what the punchline is that it's actually easier to do BSA compliance with open public permissionless blockchains than it is with traditional systems, especially with physical cash, because everything is traceable. I encourage everyone who wants to learn, if you haven't dug in yet, to read a book called Tracers in the Dark. I forget who authored that, but I encourage every bank that is looking into this to buy that book for their board directors and ask them to read it, because you will learn how the clustering technology works that started at Stanford about 10 years ago, that started to de-anonymize the blockchain. It's pseudonymous. Thank you. Yes, Andy Greenberg, thank you for posting that on the chat. Andy Greenberg is the author. I've never met him, but his book is a page turner. It starts a little slow, but really gets into how law enforcement used these clustering technologies, which essentially just looked at wallets that were frequently transacting with each other. It's all transparent. And then they used techniques to try to figure out, once they understood the public addresses of the wallets that were frequently transacting with each other, who owned those wallets. And there are a lot of techniques that have been used, but that's how law enforcement brought down the Silk Road. And that is how the BSA compliance works. And if you are just starting on this, that's a great resource to start, and you will really enjoy reading the book. But in terms of the interoperability, this is such an important point, that if you are using a permissioned blockchain and thinking that permissioned blockchains are going to be the better path for regulated financial services, you are far better off using a centralized database that's built in a cloud network than trying to create some hybrid of a permissionless blockchain. Blockchains are meant to be shared ledger systems that are immutable and trustless. That's why they are so valuable. And it's fascinating, the history of payment systems. Will was alluding to this, that historically the big payment systems in the US have all been built by the large institutions. Why is that? Why did Visa and MasterCard and even Zelle, why were they all started by the large banks? Because it literally cost billions and billions to build them. And what's fascinating is that Vantage and Custodia are small institutions, and yet we've been endorsed by the Texas Bankers Association. There's more coming. We recently announced an agreement with a loan participation automation company called Participate that has 600 banks in its network to automate loan participations and servicing. And we will be the tokenized dollar for that system. Why is it that small banks are able to do this? The answer is because of permissionless blockchain ledgers pushing down the cost of building these payment systems. And for the first time really in US history, small banks can afford to get together and do it for millions, not billions and billions. If you're going to revert back to permissioned blockchains, though, you're now back in that category of it will cost you billions to build. You may as well just go with the permissionless systems, which are now really battle tested. There was a great podcast with Raoul Pal, who that was just released yesterday, and a famous quote was going around on social media where he predicted, he's a big hedge fund guy who now runs Real Vision. He predicted that the banking system in a few years will be running on Ethereum. And I think he's right.
Thank you for that. And for all of these resources as well. I feel like I have my reading list to go. And Caitlin, wanted to stick with you and switch gears just a little bit and think about, we've been talking at a high level about blockchain-based technologies and tokenization. But one of the issues playing out right now in the market is this concept of payment stablecoins and tokenized deposits, and what some of the key differences are there. How tell us a little bit about your Custodia's journey through thinking through those products and where you've landed.
Yes, well, we've landed on payment stablecoins are interesting. It's a 315 billion with a B market, but the banking system has 5.7 trillion with a T of demand deposits and 19 trillion of total deposits. That's the total addressable market for tokenizing traditional bank deposits. It's far, far, far bigger than the addressable market for stablecoins, which, let's be honest, is mostly about the 24/7 crypto trading markets. The technology, however, can be adopted into the banking system, and that's what Vantage and Custodia are doing. What we've built is tokenized deposits that enable banks in a seamless method and accretive in year one with very little implementation, because it's a side core running next to your core for banks of any size, by the way. The large banks can interact with us on an API basis. The small banks just basically run this through a side core, maybe through a widget on their online banking. Very simple. But the point is that all of the traditional bank deposits can be tokenized. If a customer wants to take that deposit out of the network, the token programmatically converts to a payment stablecoin that complies with the Genius Act. That all happens automatically. The dollars move on Vantage's balance sheet between a tokenized deposit, which is basically a correspondent banking relationship, so traditional correspondent banking account, and the dollars would then move to a payment stablecoin reserve account that complies with the Genius Act. But here's the kicker. The moment the customer brings the deposit back into the banking system, there's an automatic pipe that goes back to the originating bank. And that is how it protects the bank's core deposits. And it just programmatically converts back from a stablecoin to a tokenized deposit. So it makes it a lot less scary for traditional banks who are worried, rightfully, about protecting core deposits from disintermediation by non-bank issued stablecoins. It creates a direct pipe for the money to come back into the originating bank. JP Morgan released a study in 2023 with its own anonymized data that looked at the crypto bull market of 2020 and discovered that 88% of the deposits that migrated to Coinbase never came back. Now, part of that is there's a lot of friction to bring the deposits back into the banking system. That friction, of course, is reduced. A lot of folks were worried about their bank accounts being closed because the compliance officers would flag them as high risk, et cetera. That's no longer happening in most places. But the honest truth is that the deposits, once they migrated away, just a lot of them didn't come back. And that is a real concern. And because this is a system that's been designed by a very talented system architect that has been in the banking industry for 30 years, we found a way to bring the deposits back into the banking system to the originating bank.
Thank you. And John, how important though is scale in this business? So in the payment stablecoin market, there's two players really dominate scale right now.
Yeah.
Why would investors look to back a bank-led project like Caitlin's describing? How do you see that?
Yeah, for sure. Well, I think competition breeds innovation, right? And I think this has been a challenging space in the US. I think Tether built their business outside of the US by, kind of being the cash leg of crypto without competition for many years, right? And then Circle kind of entered and has become a very large player. I think the Genius Act getting signed into law last summer, and I think we're probably very close, if not imminent, to rules writing being published to allow for U.S. issuers to apply for a license. I think the entrance of new stablecoin issuers to the country will just make these things function better and will help. It will help us achieve scale across the U.S. a lot more quickly when there's more diversity in the equation. And scale is really important for us, as you'd expect, right? Like, some of the work Caitlin and I did was trying to translate our ideas to the SEC and get folks comfortable with these future states that we were envisioning. Again, several years too early, right? But the benefit now that we have Genius and we're going to get something called the Clarity Act, which is like a market structure bill for tokenization of crypto. That seems to be imminent as well. We have the main US exchanges now raising their hands around both stablecoins and tokenization. The DTCC, like firms like Vanguard and the big banks, we need a mix, right? We need a mix of the fintechs pushing the innovation boundaries, but we also need the incumbents to sort of modernize and come along. And so we've explored that area of partnership quite a bit over the years and have really seen some effective outcomes from it.
That's great. Well, then kind of last theme here, we just have a couple of minutes, but y'all are, thinking, John brought up regulators and Caitlin has talked about it too. Like in your view, not affiliated with a bank or a specific fintech right now, are the regulators helping or hurting? Kind of what more can they be doing?
I think very simply, the design element has to fundamentally change from entity-based regulation, easy for me to say, but to activity-based regulation. So if you're moving money, if you're warehousing data, if you're lending, whether you're a bank, a trust company, a fintech, the regulation must apply. And the principles of regulation must apply. So that's my quick take. One comment about interoperability and standardization. This is one of my colleagues at the Bretton Woods Finance Working Group Committee on Digital Finance said, standards are like toothbrushes. Everybody wants to use theirs. That's the hurdle we have to overcome.
I kind of want to end it there, but we've got 2 more minutes, so that was excellent. All right, well, so I'm going to give you a last kind of rapid fire questions that we'll go through here. What is one payments use case that will be mainstream in 2 years? And we'll start at the end here, Yawar.
So I actually think that bilateral payments across the world, as opposed to multilateral payments, will become normalized given the increasing activity of payments as a weapon of foreign policy.
Okay. Well, you want to comment?
I'm going to align with something actually Caitlin touched on a little earlier, was that I think you're going to see interoperability happen between bank deposit tokens.
Look forward to that, yes.
I think you're going to start to see the next evolution of investment products. Like we've had the mutual fund for decades. We've now had the ETF for decades. One of the promises of this space is programmable, composable assets. And I'm really excited about that.
Excellent. Caitlin, to you, a payments use case that
Yes.
will be mainstream in 2 years?
I think it will be bank-to-bank tokens. I think Will is right. It's bank-to-bank payments, and the interoperability is so important, which is why we are committed to building without walled gardens, because the community banks, of course, aren't big enough to build their own walled gardens. So interoperable permissionless backend is the method that I think achieves the bank-to-bank payments. But it's the easiest place for banks to get started as well, because and again, this announcement we made with Participate to automate loan participations, that is all right now, for the most part, done in paper and using fax machines still. And the origination and servicing of loan participations across sometimes 100 different banks in a syndicate, if that can be automated, that is a huge cost saving. But you've got to get the digital dollar to be added to the platform, which is why we think that's such a great use case for banks to get started with.
Fantastic. Well, please join me in thanking this panel. I'm sure there's so many more topics we could have covered.